would like to provide a brief overview of our financial liquidity ratio based on the 2023 financial ratio. So this is our financial ratio analysis as for 2021 to 2023. So firstly, we can see that our current ratio is at 7.75. This means that we have more than 7 times of our current asset that we can to cover our short-term liabilities. So while our current ratio is strong in liquidity, this also suggests that we may have inefficiency in managing our current asset. Okay, moving on to our quick ratio. Our quick ratio currently stands at 3.09, and this means that we have 3 times the liquid resources needed to meet our short-term obligation. So this indicates that our company is in a healthy financial position. Lastly, our current ratio is significantly lower than our previous year, which is at 2021 and 2022. So currently it stands at 0.08. So this means that our cash reserve is limited than our liability. However, a low cash ratio does highlight a potential risk if there are unexpected expenses that need to be covered. That is all for our financial ratio analysis. Is there any questions?
I have one question. What can you do to improve your company cash collection and cash flow based on your decreasing on the cash ratio at 2023?
I will invite.
Hello everyone. I am the cash manager. So let's move on to your questions. So as we all know, even though our company's liquidity is high, but our cash ratio is decreasing from the previous year. So our company have made a solution which we can consider, such as we can do a short-term investment such as marketable securities, where it is easier for us to buy and sell them back, and we can also convert to cash at a reasonable price. So that is one of the solutions that we provide to avoid this cash ratio to decreasing for the next year.
That's good. Thank you. But I have a question.
Yes.
What is your company current policy?
I think for this question, I will invite my economics manager.
Alright, thank you.
Good morning everyone, I'm economics manager. So today I want to share our current credit policy. So the efficiency of our current credit policy needs attention, particularly with the average collection period increasing to 84 days in 2022. This reflects on our receiving payment from our customer, impacting cash flow. But our average collection period in 2023 is 60 days, which decreased from 85 days. So it is a good thing. That means that our company is collecting its receivable faster compared to the previous year. This indicates improved efficiency in managing credit and cash flow, as the company gets its cash sooner to reinvest in operation or pay off our liabilities.
That's all?
Yeah.
Okay. But how can you strengthen your current credit policy? May I know?
Maybe we can implementing stricter credit checks and offering earlier payment discount that that can reduce our collection period. So by evaluating that creditworthiness of new and existing customer carefully, we minimize the risk of delay payment while maintaining trust.
Alright, thank you. Alright. I see from all of your team, it's a good presentation. I can see. Okay. We as the investor relations officer, our role is to communicate Siam Berhad's liquidity challenges and strategies to stakeholders transparently. And it also becomes our priority to maintain transparency and build trust with our investor. Can I suggest to you what can we do?
Yes, sure.
Alright. I suggest how about we optimizing inventory management by adapting just-in-time inventory strategy. This inventory where the inventory can be purchased only when needed for immediate production or sales. This approach can also help reduce storage costs and minimize the risk of overstocking.
Can I add one more thing also?
Okay.
We also can optimize the inventory management, like my colleague also said, by improving the relationship between your company and the supplier, which is maybe you can negotiate better payment terms or delivery schedule with your supplier, so it allows your company to maintain lower inventory level while ensuring the quick replenishment.
Okay, thank you for your opinions. I think we can consider to include in our
Yes, thank you.
Thank you.
Morning, everyone. For today's meeting, we will discuss on our company's leverage ratio for 2023. So firstly, for our company's debt equity ratio in 2021, as you can see, it is 50%. And in 2022, it's 45%. However, in 2023, it increases to 289.23%. This shows a significant increase, which requires risk management. Next, as you can see, the company's debt asset ratio has improved from 2021 to 50% in 2022, but rise up to 74.31% in 2023, which indicates potential over leverage and decreases in asset quality. Lastly, the interest coverage also has improved from 2.7 times in 2021 to 4.3 times in 2023, which shows a better ability to cover interest payment.
Okay, so basically based on the company leverage ratio analysis for 2023 that our CFO has presented, Siam Berhad has an increment in terms of their debt to equity ratio, which means this company more relies on their debt repayment. Moreover, the debt to asset ratio for 2023 also has a higher ratio than in years 2021 and 2022, which means that the company mostly buys the asset from the money they borrow. Thus, it increased the company's debt.
However, the interest coverage ratio for 2023 has higher ratio than previous year. That shows this company has the ability to pay for the interest payment on time. In summary, Siam Berhad has a higher financial risk than the previous year.
Based on the analysis ratio that has been presented, I think our company is taking more debt and making more borrowing this year. This shows that our finances have a higher risk, which can increase the risk of cash shortage, leading to delayed payments to suppliers or employees. If the company changes or rates go up, it might also strain our ability to repay them. Moreover, it also will impact our investor and stakeholder confidence. If our financial risk is high, the shareholder may be reluctant to invest further if they perceive the company has financially is unstable.
Yes, I agree with you, Nia. As we all know, debt can be an effective instrument for expanding our finances, but it also carries responsibilities and hazard that can limit our operational flexibility. In the long run, high debt could also make it difficult to secure funding for future projects if lenders see us as a high-risk borrowers. It also comes with a fixed payment regardless of how well or poorly our business is performing. Those payments must be made. This makes it harder to adjust our spending when market condition change or if we face unexpected challenges. As a result, this reduces our flexibility to adjust spending based on operational priorities or market condition.
So now that we know the problem, do you guys have any idea on how can we reduce the risk?
I think we can reduce our debt by refinancing high interest debt or repaying loans using the available cash flow or profits to reduce the liabilities.
I also think that we can increase the equity by issuing new stocks or attracting some investor to balance the ratio.
Yes, I agree.
Yeah.
Yeah, I agree.
Okay. So I think we have come out with the solution. I hope this will improve our leverage ratio and reduce the risk on the following year. So I think that's all for our meeting today. We'll see each other for in our next meeting. So have a good day, everyone.
Thank you,
Okay.
everyone.
You too.
Hello and good morning, everyone. So in this meeting, I will walk you through our company's efficiency ratios and their significance. So firstly, as you can see, our asset turnover has dropped from 4.0 times in 2021 to 1.4 times in 2023, indicating underutilized assets that may hurt profitability. On the other hand, the inventory turnover fell from 7.0 times in 2021 to 1.78 times in 2023, pointing to a slower inventory movement due to the overstocking or weaker sales. Finally, our receivable turnover has declined from 5.0 times in 2021 to 3.09 times in 2023, showing a delay in customer payments, which could impact cash flow. So, from this presentation, can you guys identify which areas that need to be improved?
Based on the significant decline, shows slow inventory movement with an inventory turnover of 2023, which is 1.78 times rather than 2022 with 5 times and 2021 with 7 times. This leads to higher holding costs and potential obsolescence. I recommend we use inventory forecasting tools by using uh, historical sales data, market trends, and predictive analytics to accurately estimate future demand. This is to align stock levels with demand patterns and prevent overstocking or stockouts.
Can I add another strategy too?
Yeah, sure.
I think in terms of the sales strategies, we need to closely examine our sales data to identify which products or services are performing well and which are lagging. If we can identify the weakness, we can shift resources and effort to better performing items or markets. Meanwhile, for sales channel optimization, we need to analyze which channels are most effective in reaching our target audience and generating consistent revenue, whether in store, online platform, third-party vendors, or direct sales. If certain channels are underperforming, we must decide whether to improve them or shift resources to better performing ones.
I also have another strategy for how we can improve our sales efficiency and boost revenue for Sayang Berhad. After reviewing our financial data, I identified two key areas that need attention, which is improving payment collection by introducing stricter credit policies, by limiting credit terms for high risk customer and setting clear payment deadlines. We can also offer early payments discount as an incentive for customer to pay faster, improving cash flow and reducing delays. Secondly, we can analyze the market trends and competitive pricing to ensure our price remain competitive. We should more focus on high margin products and consider discount or bundles to attract more customer while maintaining profitability.
Oh, I see. I think that's a great idea. Any other suggestions before we end our discussion?
Yes, I have. I think we are lacking in terms of having productive employees who don't know how to manage more sales or use technology effectively. This is because efficient staff can better manage stock, reduce access, and move inventory more quickly. They can also prompt invoice management and employee follow-up to collect customer payments. Regarding this issue, I think we should invest in training and development initiatives to increase workforce productivity. Firstly, we can teach every employee how to effectively manage stock levels and optimize the inventory process, such as teaching them how to use inventory software to improve stock handling. Secondly, we can also improve employees' ability to close sales and improve customer satisfaction, such as managing customer complaints and feedback effectively. And lastly, we can also teach them how to effectively communicate with customers for payment follow-up.
Okay, I see. I think that is all for today. Thank you for all of your contribution and sharing your insights to this issue. So we'll see each other in our next meeting. Thank you, everyone.
All right, thank
Okay,
you.
thank you.
Thank you.
Hello and good morning, everyone. So today I'm here to share Science per Height profitability ratio for the year 2023. Okay, so as you can see on your file, firstly, our gross profit margin this year is at 49%, reflecting high efficiency and cost management. However, our net profit has a low percentage of 0.83%, indicating that our company is facing challenges in managing operating expenses and other costs. Similarly, our return on asset is at 0.94% and return on equity declined to 3.66%, signaling reduced profitability from our assets and shareholder equity. So, based on this profitability ratio, can finance analysts make the comparison from the previous year?
Yeah, sure. So basically, based on the analysis of the company's profit ratio for the year 2023, Sayang Berhad experienced an increase in the gross profit ratio when compared to the previous year, which is in 2021. The gross profit ratio is 6.5% and in 2022, 7.5%. So this means that our company managed its production costs and pricing strategies well. However, the net profit margin ratio for 2023 is decreasing compared to 2021 and 2022, which are 7.5% and 9% respectively. This low profit margin means that our company is showing inefficiency and shows the needs for better cost management and revenue expansion. Okay.
Other than that, the return on asset ratio for 2023 has a lower ratio than the previous year, which is 8.6% in 2021 and 9.5% in 2022. This shows that our company is not generating much profit. from its asset, which could indicate underutilized resources such as the facilities and equipment. Finally, the return on equity ratio in 2023 also shows that the ROE is weaker than in the previous year, which is 41% in 2021 and 42% in 2022. This means our company is not generating enough returns for our shareholders. This may be due to low profitability or the level of debt diluting the height of return on return equity.
Okay, so can any of you guys evaluate the profitability ratios in order to find areas for expansion? This is because having a high gross margin is not enough to guarantee Siam Berhad's sustainable growth and value for shareholders. So addressing these lower percentages will be our top priority.
Okay, look at the financial. The gross profit margin improved to 6.5% to 7.5%. This is a good sign, but I need to check if our marketing efforts are helping enough. First of all, I'll check if our prices are set right to attract customers and still make profits. Next, look at how well our ads and promotion are working. Are they reaching the right people? And lastly, I'll see if we are keeping customer loyal and selling more to them. If needed, I will suggest changes like better advertising or promotion, or discount for loyal customer to increase sales and profits.
Okay, I see. Well done, Dania, for having such a great idea. What about the operation manager's perspective?
Yes, sure. After analyzing Siam Berhad's financial data, I have identified key areas for improvement. The first one, in 2023, the cost of goods sold was 11,506 ringgit, about 51% of sales revenue. While manageable, reducing this percentage could improve our gross profit margin, currently at 7.5%. I think we can explore better pricing negotiation with suppliers. Next, for inventory turnover, dropped to 5.0 times from 7.0 in 2021, and the average collection period increased to 85 days from 72. Therefore, we can implement tighter inventory management and improve demand forecasting. I suggest we can Next is operating expenses that increased to 5,332 ringgit, nearly 24% of sales revenue. I suggest we can conduct an audit to identify waste and inefficiencies. Lastly, for depreciation, 700 ringgit in 2023 reflects asset wear and tear. I think we need to have a regular maintenance of machinery that can extend assets lifespan and reduce long-term depreciation costs.
Right, thank you for your insight. Okay, so good job everyone. I think that is all for today, and thank you for all of your ideas and contributions.
Thank you.